Hello everyone, this is Tom Fox. I'm the Compliance Evangelist, and I'd like to welcome you to a special 5-part Compliance Into the Weeds podcast series. This week, Matt Kelly and I are going to focus on the new FASB Revenue Recognition Standards. Each day, we will take a different topic and in a short 10-minute podcast, give you the highlights of what we think are important. We have coupled this podcast series with an ebook we've released, which will be in the show notes, that you can take a look at some of the key components of this new revenue recognition standard. On day one, we'll introduce the new revenue recognition standard and its implementation timeline. On day two, we will consider how you should determine transaction price going forward. On day three, we're going to take a look at the specific software sector and how this new revenue recognition standard can shake up that industry, that sector. On day four, we'll take a look at disclosures, ICFR audits, and what the PCAOB has published on this new revenue recognition standard. And Friday, we'll wrap it up, and I will tie it into what I think is the importance for the compliance practitioner. I hope you will enjoy this new podcast format series that Matt and I put together. We've certainly enjoyed researching it and recording it for you. Compliance Into the Weeds is a part of the Compliance Podcast Network. Hello, everyone. This is Tom Fox, back again with Matt Kelly in our 5-day exploration of the new RevRec standards. Today, we're going to take a look at disclosures, ICFR, and how do you audit under these new standards. So, Matt, you want to lay the ground for us on this one?
Sure. There are a couple of different ways that I think the audit firms are going to respond to this. And everybody should be under no illusions. Like the audit firm's regulator, the Public Company Accounting Oversight Board, they've already told auditors, you need to pay attention to this. They will be thinking about the new revenue recognition standard when they do this audit. Ideally, even now, as you're listening to it, you have already been talking with your audit firm about how this audit is likely to transpire. But in a couple of different ways. First, as Tom, you and I mentioned, I think in segment 2, the company, you're going to need to use more judgment making your definitions or defining what your transactions are and the values there. So you're going to need to document that. You're going to need to show the judgment to the audit firms. And they're going to probably be looking more closely at your judgment. They would be doing that anyways because a judgment-based decision is much more subjective than a sort of, is there $10 in the account or not? That's very objective. But secondly, auditors themselves do have their own new inspection standards that they have to pay more attention to judgment across the board. And now there's going to be more judgment in some of the most important revenue line or financial lines that they look at. So secondly, I think that they will be looking more closely at fraud risk because, as we said, I think in segment 3 the other day, there will be some circumstances where sales commissions could be higher because of the new revenue standard that would let some firms recognize more of a transaction more quickly. So there may be some incentives for sales executives to juice the numbers a bit or to close the deal really quickly to hit a bonus. And is that going to be legit or not? Would it be such pressure that it might transgress into fraud? Possibly. But I don't think we all fully understand the fraud risk implications of this standard yet. But the PCAOB published an alert to its audit firm regulatees saying, look at fraud risk. This is going to be an issue. So they'll be looking at fraud risk. And then thirdly, around internal control of financial reporting and ICFR, I can give you one good example that one thing that comes up a lot with ICFR audits is the completeness and accuracy of reports. The audit firm wants to know when they say, show us all of the contracts, you say, here are all of the contracts in our system. Well, how do we know that all those contracts is complete and accurate? How do we know that your system wasn't somehow tampered with? What are the controls around these programs you might use to manage your financial transactions? I think as we shift to talking more about what contracts are, how these contracts are defining transactions. A big follow-on question is going to be, are we capturing all of the contracts that our employees are generating? Are we sure about that? Are we sure that they're not generating some contracts somewhere else and they haven't told us and our system hasn't captured it? Are we sure that they didn't come into the system later on because we gave them improper access controls and salesperson logged on as a super user admin and changed the term of the deal afterwards? How are we going to be able to prove that our systems have the security and access controls that we need to be able to show we have a complete and accurate report of all activity, Mr. Audit Firm? Here you go. You can study it. It's going to be questions like that I think will come up more and more often. And just to add yet another level of complexity here is the technology companies are using is driving up the risks around access controls and completeness and accuracy and whatnot, which is going to mean you have to pay more attention to these things, and your audit firm is under more pressure to pay more attention to them. And we're looking at, all of these complex systems are now governing more complex transactions. It's going to be a sticky thing to get through for the next few years. But that's where we're going broadly. It's going to be ICFR, it's going to be fraud risk, it's going to be documentation. I suppose it's probably not news in the grand scheme of things. You always have to worry about that, but it's going to be much more difficult to worry about it effectively, and the audit firms are going to be worried much more about it as well.
So a couple of things that I wanted to follow up on, Matt. In many businesses, it's not that you have an oral contract. You do have a written contract, but your business practice may actually differ from your contract. So the classic example is if you have payment terms, 30, 60, 90 days, whatever they may be, that's only really not even a suggestion, but sort of a starting point. 30 days means 60 days, and 60 days may mean 90 or 120 days. Here in Houston, we're still sort of in the throes of a downturn in the energy sector. So payment terms are being extended really no matter what the contract says. It seems like to me that now you really have to take a look at what's your business practice. And you have to ascertain that from a variety of people. Obviously, the people that are executing on the contract have to opine or at least give some information, but also accounts payable and collections, whatever the department may be, your CFO within your organization. If it's a major contract, one of your top 10 contracts, you're going to have to be able to justify that the contract terms show your business practice actually pairs up with what your contract terms before we even get to the situation of side agreements or oral deals or any of the other myriad rebates, discounts, or other paybacks that a customer may have. And it's going to require a lot more documentation to present even to your own auditor.
That's very true. And I think, where I'm zeroing in, just because I happened to be at a technology conference not long ago where this came up, is especially for companies that are in some sort of fast growth mode. And, look, the economy is doing very well these days. What do you do when you need more and more employees to be able to process more information? You just say, let them be a super user for a couple of days. Let's have the whole department be super users. And suddenly your ability to govern what the transactions are and how they flow from one step to the next, that goes out the window. And audit firms are going to zero right in on that because, could any single contract be a material risk of financial statement restatement? Possibly, if it's a really big customer. But if you don't have a way to govern all of the contracts and you've got somebody changing it from 30 days to 90 days repayment without telling anyone, and you don't discover this until you're halfway through the audit, sure, that could lead to a very big weakness of some kind. That could lead to all sorts of trouble. So you're going to need to think through, what is our process to be able to produce reliable information that we can give to auditors, both on the documentation side and just to be able to prove to them that our controls are working and solid so that the evidence we're showing them isn't been tampered with, that it is reliable. And somewhat to my surprise, the fact of the matter is that this is going to be trickier to do in a robust high-growth economy than in a slower no-growth economy like we saw in 2009 or 2010.
So, and I guess now I actually see a continuum from even working backward from the PCAOB to audits to the disclosures companies may have to make. Generally accepted that if it's only material that you have to make the disclosure, but there are a myriad of rules that certainly I work under where materiality is not a standard. And so at what point does the lack of materiality of a contract outside the United States make your books and records not correct, leading to a potential exposure under a law unrelated to traditional revenue recognition?
That is certainly something that people need to think about. Now, the correct answer, and we can get more into this probably in our final podcast, is that you should already have been talking with your audit firm for a while to plan these things out. But people cannot forget that these sort of complexities, they're not to be dismissed because we don't know when they might boil up and suddenly grab you in the rear end. And when that happens, it will happen at the least convenient time and cause the most pain. So that's what people should be thinking about.
Well, Matt, this has been a fascinating exploration. I hope everyone has enjoyed day 4 of our 5-part series on the new RevRec standards, and I hope you will join us tomorrow where we try to wrap up with some concluding thoughts on what it all might mean. Thank you. Hello, everyone. This is Tom Fox again. I'd like to thank you for listening to this episode of our 5-part series on the new FASB Revenue Recognition Standards. If you have any questions on this new standard of Matt and I, you can email me at tfox@tfoxlaw.com. You can email Matt at mkelly@radicalcompliance.com. If you have listened to this podcast on iTunes, I would greatly appreciate it if you would rate our podcast, as it would help our rankings and help get the word out about the only weekly compliance podcast that takes a deep dive into a subject such as the new FASB Revenue Recognition Standards. Thank you again for listening. I hope you'll join us tomorrow. Compliance Into the Weeds is a part of the Compliance Podcast Network.